Oh, you're recording with video. Oh,
I'm not.
I thought you were just doing voice. Okay, so if you're making over 40, the cusp is kind of 40 to 50. If you're making 40 to 50 in commissions and you're still filing as a Schedule C filer, you know this, you don't have a lot of deductions. You have mileage, you have lockbox, you have dues, some fees, but you don't have a lot of expenses. As a Schedule C filer, whatever you're left with after your expenses is fully taxed for self-employment tax, also called Social Security and Medicare, also called FICA. It's 15.3%. When you convert to an S corporation, you determine what your W-2 income is going to be, and that's what you pay the 15.3% on. So in our example, it's a $100,000 example, and it can be 70, it can be 80, it can be 60, but we just used a nice round number for 100,000. And when you're a Schedule C filer, you're going to pay $12,000 in self-employment tax. When you're an S corporation, we assume $40,000 in W-2 income. You'll pay $6,000 in FICA tax, self-employment tax, all called the same thing. Mm-hmm. And basically what happens is when you're an S corp, you have to take what's called reasonable compensation. And I define reasonable as something I can defend. So if we're ever in an audit with an IRS agent, I can't defend $1. I can't defend $1,000. But reasonable compensation is a very subjective number. It's a very subjective decision. But there are unreasonable numbers like $1,000, right? But $40,000 on $100,000 of income, $20,000 expenses, you take $40,000 in salary, now we're at $60,000 deduction. I can defend that. I could defend probably 35. I could defend 55, somewhere in that range. And what we tell people is you don't have to make a decision what your income is going to be. You're going to do a little bit each quarter. And at the end of the year, when the tax plan comes together, if we need to increase, we increase. If we need to decrease, we basically can file a zero return. We have a very simple package that's a quarterly package. It allows us to update your numbers once a quarter. We file one payroll per quarter, we file your payroll returns per quarter, and we do the tax planning in September. That gives us an opportunity to look at where you are year to date, project out where we think you're going to end, and then we can start looking at other options for you to lower your tax bill. That's the second part of everything. When you become an S corporation, you have other options for you for retirement planning. You can do a self-employed pension, you can do a solo K, you can do other things you can do, health insurance, health spending accounts, HSA plans are fully deductible. So there's a lot of different options that you have available to you that are not available on the Schedule C. The other thing is on a Schedule C, you can't deduct any meals and entertainment, 0% deductible. As an S corporation, you can deduct 50%. Schedule C is 0.
We were just talking about
at the gun range.
We thought that the meals and entertainment was taking off.
Nope, not in a Schedule C anymore. That changed in the 2017 Tax Cuts and Jobs Act. It was fully eliminated.
For S corp, you can do
Schedule
it.
C. S corp, you can take 50%. And this year in 2022 only, and back in 2021, which might benefit you, you could take 100% because it came out in one of the COVID legislation pieces. They said to benefit restaurants, you could take 100% of all meals eaten in restaurants in 2021 and 2022.
Wow. Dig up your receipts,
As
girl.
For business, yes, for business.
You don't have to. Credit card statements.
Perfect.
So
I told you I'm OCD.
Okay, so great point. Credit card statements. You need to keep all your receipts. Credit card statements do not hold up in an audit. The IRS wants to see an actual receipt. Now, best way you can do that, there are multiple apps on your phone and electronic accounts. We use an app called HubDoc. We actually manage the application, but you put it on your phone. You go out to dinner, you open your HubDoc app, you sign your receipt, you take a picture. I don't care what you do with the paper. It uploads into the portal. We then save it for you in HubDoc, QuickBooks, and in our Citrix files.
I told you.
If you just do everything electronically, you'll be fine. But credit card statements and bank statements will not hold up in an audit. The IRS physically wants to see the actual paper receipt. It's crazy, but that's the rule.
So you're saying HubDocs will be able to hold up in an audit?
Yeah, HubDoc is an app that we actually just use to post through QuickBooks, but it gives you a digital image of the receipt, identical, like literally you take a picture and it's there. And it uploads automatically. There's no fancy buttons to push. It's go to the camera, take a picture, it's done. And then I don't care what
You
you do
just
with
get
the
rid of
paper.
the receipt.
Well, I already do that with my receipts, but I do that with Fetch.
You can use any app as long as somebody can access those. We like to keep them in our files so that we keep everything electronic. We don't do paper unless somebody really wants to bring us paper. If they bring us paper, we scan it all. So you really want to keep those receipts. But the big thing is to look at your income. And if you're doing over 40,000, you will absolutely benefit from being an S corporation. Now, the downside comes with you won't be using TurboTax. You're going to need to have us file your return. You're going to need to have us do your payroll. Because these models or these transaction models are very simple, there's not a lot to them. You're going to have your commission checks, you're going to have a few expenses, and you're going to have some payroll and payroll taxes. We do a quarterly package. It's including the return prep and the tax projections. It's $2,500 a year. That's it. That's your tax returns. That's your tax planning. That's your bookkeeping. That's your payroll. So $2,500 a year. It's drafted quarterly. That gets you in and out, and you don't have to worry about anything. And we will, when we prepare your tax plan, we actually sit with you and go through your tax plan and ask you, do you want retirement planning options? Do you want health options? As your commissions grow, like we were just discussing with Kayla and Josh, you can add your kids onto payroll at a certain age. You can do educational IRAs. There's, yes, child labor deductions.
Oh yeah.
There's other ways to do things. And there's lots of different options when you have an LLC with the S corporation election. Mm-hmm. So just forming the LLC doesn't do it. We have to have the S election sent into the IRS. Once it gets accepted, then you're good to go. And then we can start throwing a bunch of different options on the table for you and seeing what you like. And when I tell people, so you're just getting started, right? This is your second year. Mm-hmm. As you grow in the business and your income grows, you don't have to throw everything in the kitchen sink on year one. You can work towards different options. So like right now we have a corporation with 3 individuals in it. We're starting them out with a simple IRA. It's a very simple program. It doesn't require a lot of administration fees, but as they grow and as their income grows, they'll grow into bigger retirement planning options. They'll cost a little bit more, but as you make more, you need to save more. So there's all kinds of different things that you have available to you. And what I tell people is the only way to win the game is to know the rules. We know all the rules. And we know every single option available to you to take as a deduction. And so we're gonna give you all the different options and you can pick and choose. And you don't have to choose everything in the first year. You can stair step your way into bigger and bigger deductions. But the biggest option is, even with TurboTax or Quicken or any of these other programs, they're gonna make some really basic recommendations to you, but they're not going to do a deep dive into what works for you personally, because that program is made for millions of people. Mm-hmm. We talk to each client individually and sit down and say, what can we do for your specific situation to save you money? Mm-hmm. And we're gonna tell you things like, you need to keep your receipts. Bank statements and credit card statements don't hold up. Use a mileage app. There are tons of mileage apps. There are free ones, there are paid ones. Take all your mileage, because you guys are driving around. That's one of your biggest deductions. Right. Mile IQ is an app on your phone. There's one called Driver's Note, which is less expensive. They both work the same way. Mile IQ is just very well known. But keep your mileage, keep your lockbox receipts, keep all your dues receipts, keep your meals and entertainment receipts. And when I say keep, I mean take a picture of it, upload it into an app, be done with the paper. The best way to do this, do it quarterly. We'll tell you if you need to make an estimated tax payment each quarter. You go online, you make your estimated tax payment, you're done. At the end of the year, there's no surprises. There's no, oh my God, I don't want to do this. There's no, oh my God, I have to sit down and pull out my shoebox of receipts. You do it each day a little bit at a time, and then it's done. Mm-hmm. And that way you're not stressing out like you're doing right now. Like, oh my God, I've got to get all my stuff together. I've got to figure out what I'm doing.
Just that one thing.
Yeah.
I already take pictures of
So,
the
Andrea,
receipt.
That's great.
I have a couple of rentals.
Okay.
Is that included in this, or is that separate?
That would be one extra schedule. It's $25 per property. It's just a Schedule E.
Okay.
And do you have a separate bank account for those rentals?
No.
Okay, that's fine. What we tell people is download your bank activity into Excel. If you're comfortable doing that, tell us where all the income is and give us all the expenses.
I have it in
You
Quicken,
sum it.
and I can
Oh,
put it
even
in
better.
Excel.
Even better.
Even better.
Quicken is
Yeah.
fine. Quicken is fine. Schedule E's are just $25 a property. And they do factor into that.
And then I have a capital loss that I've been dragging is gonna be another 75 years before it expires. So,
That just goes on the schedule and it just keeps going on and going on. Yeah, we just add that in.
okay.
Yeah, the system will automatically deduct it. Now, on your rentals, are you actively purchasing additional properties?
Likelihood,
Okay.
not yet.
Okay, I'm going to quickly talk about something called cost segregation. Has anybody heard? Because I talked about it with Kaylee and she was like, I don't know about this. I'm like, you need to know about this.
Mind blown.
Okay, cost segregation is an IRS allowed deduction, and it's a fancy word for you hire a cost segregation company to do a report on your property. So it has to be a rental property. It can be commercial or residential. It can be an apartment. It can be a condo. It can be an Airbnb. It doesn't matter. It just cannot be your primary residence. When you put a rental home on your depreciation schedule, you buy the home. If there's a land value, we typically use 10% of the total purchase price to land, which is not depreciable. Some people use 10%, people use 20%.
This is the one where it depreciates each year.
You actually get a first year huge deduction when you do cost segregation that you normally would not. So I'll give you an example. We have a client who had bought 4 properties last year. They're all either vacation rentals or long-term rentals. And we have a lot of clients that do this, but we have bigger commercial clients that have multi-million dollar buildings. So I'm going to use a residential rental example. He did cost seg on every single one of those. He got 20% additional first year deduction on his return, because what the cost segregation company does is they will use your construction drawings if you have them, or they'll use, they'll use Google Maps, they'll use basic engineering. These are all engineers. And the engineers take your property and they break it down into what's called components. And the components come down to 5 to 7 year property, 10-year property, 12-year property, and then everything else goes into 27.5 or 31, depending on whether it's a long-term rental or a short-term rental. And what the engineers do is they break that property down into these bite-sized component pieces, and you're allowed to take accelerated depreciation in the first year. And so all of the 5, 7, 10, and 12-year property, you get to take 100% of it in the first year. If you don't have enough income to take the full deduction, it carries forward to the next year. And you can do cost segregation on every single property.
That's cool.
It's very cool. It's a huge deduction. We
And
have a
it's
client
another
right
company,
now.
right? You gave me the company. I think
Yes,
it's still
it's
on my
called
notes.
ELB Consulting. They're up in, I don't know. I'm going to say Zephyr Hills because that's in my brain, but it's not Zephyr Hills. It's somewhere here. But that's one of the ones, that's the company that our bigger commercial clients have used. They do properties all over the U.S. It can be, you could purchase anywhere. So we have a client in Texas right now. They're building a vacation rental in South Texas. It's $1.1 million. I did a basic calculation for them yesterday, and they'll have about $150,000 reduction of taxable income, which equates in their tax bracket, it's about a $10,000 to $20,000 deduction of tax in the first year. Then they're going to get the ongoing depreciation remaining every single year until it's used up. The great thing about cost seg though is that you can buy 4, 5, 6 rentals, and if you buy them one after another each year, you're getting a big deduction each year. And if you can't use it all, it just continues rolling forward. So if you're investing in rental properties, that's do the cost seg. The report will cost you anywhere from $1,500 to $2,000, but it can get you a $10,000 to $15,000 deduction or higher.
But it's
a good ROI.
Right when you sell.
Yeah, and depreciation recapture. But again, if you're going 7 to 10 year investment, your depreciation recapture will be very minimal. But if you do it now, if you turn around, if you're going to flip, don't do cost seg. It'll come back to bite you in the next year when you sell, because you'll get a depreciation recapture. But if your intention is to hold that property for 5 to 7 to 10 years, you won't have that. Your depreciation recapture will be very, very small.
Really?
Yeah.
How does that work?
It's just because it's the Section 179. It's only 15% of the total, usually.
I see.
But it's still a decent
So you're
number.
expensing it.
You're expensing it in the first check and the full deduction in the first year
I see.
of the 5, 7, 10, and 12 year property. So you're not taking the whole property. You still have to keep the rest of it underneath the 27.5 year. So your depreciation recaptures, the longer you go, the less the depreciation recapture is going to be. If you buy a property and you haven't done it in the first year, you can do it in year 2. There's a special form that has to be completed, but it can be done, but it's preferred to do it in the first year of purchase. Otherwise, everything goes into 27.5 and you get a little bitty teeny deduction every single year. It's very, very small. But yeah, I mean, for going back to the S corporation, what we will do for you, we charge $195. We will plug in your prior year tax return into our software. We will do a tax plan for you as if it were an S corporation. We'll show you bare bones with no additional retirement planning deductions what your tax would have been. And then we'll show you with additional retirement planning options. We can do multiple scenarios in the tax plan. We can show you if you had a health savings account or if you had a SEP or a simple IRA, what those would look like. So you can start to see what those scenarios look like. What then we do is we tell you basically if you were to do a retirement plan and you need to fund it with $6,000, if your tax savings are $4,000, it really is only costing you $2,000. You're literally taking money that you would have given to the IRS and funding your own retirement plans and or keeping in your pocket if you want to. You don't have to do retirement planning.
When you're past retirement age?
1031 later.
Yeah.
Yeah.
Yeah, unless you're 72. I think the required minimum distribution started at 72 or 73. Okay. You would have some limitations. You would have some limitations. But you would benefit from, if you're going to continue investing in rental properties, the cost segregation, but also just being an S corporation. And because of your age, you don't have to pay Medicare. You only pay Social Security. I'm sorry. And yeah, you're going to pay Medicare and not Social Security. Right. So, because you're already paying in. So there's a lot of different options, but for $195, we're going to plug in your tax return. We're going to show you what it would have looked like. And then you can decide yay or nay. I want to do it or I don't want to do it.
And the LLC is still what, $150?
The LLC is $125. That's the state fee.
At the state.
We use a company called InCorp to do all of our entity formations. And I put the fees for the actual incorporation in the handout. And I'm going to send Kaylee a couple of different handouts. We have one with just our price list for the LLC. Then we have to file for the FEAN, the S election. Those are all one-time charges in the first year. It's less than $500. You get all that done, and then it's done from there on out. All you have to do from there on out for your LLC is pay the $138.75 a year to maintain your LLC. $138.75. That's it.
But the return on investment
It's
in
huge.
total is
Yeah.
huge.
Yeah. You can
It's
save
ridiculous.
anywhere from $3,000 to $6,000 depending on what you're doing, and that's after our fees. So it's worth it. It's worth it. And also just having somebody that is giving you all the different options, because there's a lot of tax rules that change year to year and weird things come out that you're not going to know about. I mean, heck, even for us to keep up with it, it's a lot. It's a lot for all the tax rules that change. But that's the benefit of using somebody to actually do proactive tax planning. Instead of sitting down in April, on April 13th or 14th, trying to figure out what you're doing and you're under pressure and you're doing it on your own, we do proactive tax planning. We want to know where you're going to be at the end of the year. We want to know what options we can put in. If we're going to do retirement planning, we get those, we help you set those up. We have investment advisors that we work with that will guide you through the entire process. And we also offer additional services like retirement planning, wills, estates and trusts. We work with several attorneys that do that. So we really sit down and talk to you about a long-term picture because you're self-employed. The other thing I tell people is when you're self-employed, there's nobody paying your sick days. There's nobody paying you holiday pay. There's nobody paying you jury duty pay. There's nobody paying your disability insurance. There's nobody paying your life and accidental death and dismemberment. You get to provide everything for yourself when you're self-employed. And if you don't know what everything is, that can be dangerous. So we ask people, do you have a disability policy? Do you have a health policy? Do you have a will? Do you know what's going to happen to your stuff when something happens to you? If you have kids, are your kids taken care of? Do you need a trust? In your case, I would ask you where your real estate property is going to go if something happens to you. Excellent. Perfect decision. Who's administering your trust? And we have a trust attorney that we work with, Deloach and Hofstra.
Okay.
On 86 at Seminole Boulevard.
Do you have any idea of Bill Foster and Foster?
No.
Because that's neighbors across the street. Guy's 85 years old. Okay, so like, I'm 77, and I hate being the same age as all these old people, right? Because I don't belong.
Well, if he's your trusted administrator.
My 85-year-old neighbor across the street, Christian guy, just happy, just can't keep him from smiling and telling jokes. He's up there on his roof with a blower, blowing off the pine needles, right?
Is he your administrator?
Good Lord.
No, he's just
Okay.
neighbor, yeah.
As long as he's not your administrator, you're
No.
fine. If he's your administrator, you're in trouble.
Well, I don't have an administrator, and I have 4 kids scattered all over the place, and I do need. The blower guy recommended Foster. So
we use Deloach and Hofstra. They're down the street from us. They've been around. The dad has been around for
Where are
years.
you?
I'm at 102nd Avenue and Seminole Boulevard. You know where the new Circle K is going in?
No.
You know
I get
where
the picture,
Winn
yeah.
Dixie,
Yeah,
that
right,
major
right.
intersection, you got
Oh,
Walgreens
yeah,
and
yeah.
CVS.
Right.
We're on the opposite corner. There used to be a used car lot there for like 100 years. That guy got a long land lease with Circle K. He hit the jackpot, and they're putting that brand new Circle K in. But we're at that corner. Deloach and Hofstra's right down the street. We work with a rep who's the son of the founder. They've been there for a long, long time, and they actually act as administrators. So in your case, where you have 4 kids scattered about, if you want somebody to administer that trust that has they have no financial, basically, interest in all those properties, they're completely third party. We recommend them. We have some clients that have asked me to be the administrator. I'm not an administrator. I stay in my wheelhouse. But we send everybody to Deloach and Hofstra. They have great pricing. They give a great service, and they're very they're non-lawyery types. And we work with a lot of lawyers, so I can say
Deloach,
that.
you said?
Deloach and Hofstra. They're at the corner. You know where Dunkin' Donuts is
I've
on
heard
Seminole
this name
Boulevard?
before, yeah.
Yes.
Yeah, I was.
They're
about
right
to
across
say,
the
I
street.
can
Yeah,
tell you where
Jolly
Dunkin'
Joe's.
Donuts is.
Yes. They're right across the street. They just built a brand new building. There used to be a title company there, but they tore the old building down and built a brand new building. I call it the backwards building. It faces where the old building was instead of facing the street. It's just
Odd.
it's
The backwards building.
it's the backwards building to me. Like the entrance doesn't face one of the main streets; it faces the parking lot, which I thought it's weird.
To each their
But
own.
yeah, they're great. Good,
a feng shui
good
thing.
people. Yeah, maybe, but really good people. But yeah, I mean, if you want us to plug in your numbers in your case, if you need to get your taxes done, we can get you in.
I did write down a couple of questions. though.
Absolutely,
I just
fire
wanted to
away.
wait until you were done.
No, go ahead, fire away.
First of all, I was just telling her about I do my own pop-by baking and stuff like that. For grocery receipts and stuff like that, how do you do that? Is that not counted in what's receipts? Are
Is it a
taxed?
business that you actually do, or is this like for your?
Pop-buys are when you bake something or buy something and bring it to your clients. So
Past
like on
clients.
Holiday,
Oh,
It's a great
okay.
way to stay on top of mind.
Yeah, so like gifts
the
and
law
things
of
like that.
reciprocity, yeah.
Keep your receipt. All you need to do is when you go to Publix to buy those groceries, buy them separately. Well, let me back up a second. If we form an LLC for you, you're going to go open a business bank account. You need to have a business bank account. Keep everything separate. I know I've got you. You are on my you and one other client are on my list of 2 people that I need to get them to open a bank account.
it's okay. My best friend used to be a lender, so I hear it all the time.
Yeah, you want to open a business bank account. So, for example, I will buy things for the office. I buy coffee. I buy paper towels. I buy, toilet paper. I'll go to Walmart and I'll get the things that I need for the office, and I will use my debit card for the business for those items, and I put office supplies, and I put all my personal groceries on my personal debit card. So, if you're buying things like that look like they're a personal purchase, as long as what I tell people is just grab a pen, write on the receipt.
What it is.
Yeah, what it is, and you pay for it from your business account, because then it is a business expense, and don't buy your groceries on that same debit card. So I keep right here, business, personal, and I just split the orders up. If it's Amazon, I use my Amazon business account for things that we order for the office. Those are all business. Those go on the business debit card or the credit card. All my personal goes in my personal Amazon account. And as long as you notate, document's the key to winning an audit. If you're ever audited and they say, well, you can't deduct a Publix receipt. Sure I can. I was doing this for pop-by.
Yes.
Not familiar with that term. I'm going to go look it up. But yes, these are client gifts, or these are client appreciation, or I'm baking cookies for an open house. That's all relevant. That's all valid expenses. As long as you document, you're fine. But you open a business bank account as soon as you get the LLC and the FEIN.
With that said, how much of a percentage of your income is business expense? So should I do an automatic 20% towards business expenses because that's up to that much because if I'm doing a business account, I want to know how much of my income to put into the business account and what the rest of it goes.
All of it. All your commissions would go into your new business bank account, and then you will take a draw from that account to your personal.
Gotcha.
And then when we run the payroll for the quarter, we will look at how much you made, how much your expenses were, and we'll come up with a number. It might be 5,000 for the quarter, it might be 6,000 for the quarter, it might be 4,000 for the quarter. It's going to depend on how much you made and how much your expenses were. So we set up a QuickBooks file, we'll plug in your income and expenses for the quarter, we'll update that, we'll basically make a projection saying, okay, if you were to repeat this quarter 4 times for the year, where does that put you at the year end? What do we think your wages should be for the year? Divide it by 4, and that's how much we would put on each quarter. Now, as those numbers kind of ebb and flow each quarter, that's why we update quarterly. Because we want to make sure we don't want to overpay in on W-2 income. I'd want to be right at the number. I'd rather be conservative in quarter 1, quarter 2, quarter 3, and jack it up in quarter 4 if I need to. I don't want to put a higher amount, because once you put it in, you've put it in. There's no getting it back. So I'm pretty conservative in the first part of the year, and as we get closer to the end of the year, those last 2 quarters might be slightly higher. But
Conservative meaning not paying yourself the first 3 years.
First 3 quarters.
Okay,
First 3 quarters. But you'll pay something. It might be 3 or 4,000.
gotcha.
It won't be 7 or 8 or 9 or 10. Unless you get some humongous commission and we're like, oh shoot, you do need to pay in. But it's really based on each individual person's commission and income and expenses. So you're going to put everything into your business account, all your commissions, all your real estate income goes into there. Then you just take a draw. All you do is just set up an automatic transfer from business to personal, and you can draw out 100%. I don't care how much you draw. I'm going to figure out what we want to put on the W-2. And it's all the W-2 is a conversion. You're not going to get a payroll check. You're not going to get direct deposit. It just is a conversion of those distributions into W-2. It's literally us going into ADP. We put in the amount that we want for the quarter. We show that you've already taken the money out of the account. You get a $0 check, but it moves that money from a dividend over to W-2 income. And you literally get a W-2 at the year end. It'll issue you a W-2. But it's quarter by quarter, and it's based on how much you've done in that quarter. If you have a slow quarter, we might put 0 on the return. That's fine, as long as we file the returns. It can be 0. At my Kaylee's, we were doing zeros because I was like, I don't know how you've done. I don't know where you are yet. We'll put it on the 4th quarter. It's fine. As long as it's paid in by December 31st, it all counts. So
You don't have a penalty.
nope. As long as you're paid in by December 31st. And honestly, you can even you're going to make estimated tax payments. What we try to do is try to get everything in by December 31st. We want everybody to say, you earn the money between January 1 and December 31. Take out of that money what you're going to owe in tax instead of borrowing it from next year's commissions. Treat it like a business expense. Whatever you're going to owe, pay it in. Get it done. People shouldn't dread April 15th, and everybody does. But you shouldn't. It's really simple. You just do it quarter by quarter. We make sure you're fully paid in within about $100 of where we think you're going to be, and you're done. And then you start the next year off fresh, and you're good to go. It doesn't. This should not be a stressful thing.
Yeah.
Yeah. Just that easy.
Wonderful.
Can I hire my husband?
Yeah.
So his
It
gas
might not be.
expenses
It might
and
not be
stuff like that?
beneficial. Well, certain things. Okay. So in that case, what does your husband do? If you don't mind me asking.
He's an electrical engineer.
Oh, he's an electrical engineer. Okay. So does he do anything to really help you?
Yeah,
Okay.
he does. He
Does
helps
he, like-
fix things.
Helps fix things and things like that?
Yeah.
Okay. You can, but here's the problem. You're on a married filing joint return. So that's right pocket, left pocket.
Gotcha.
Now, I'm going to give you another example. Let's say you're doing like gangbusters. You're doing $200,000 in commissions or $150,000 in commissions. We set up a SEP, which is called a self-employed pension plan. You put your husband on the business, vice president, managing member, handyman, whatever you want to call him. Now you can take both of your income and you can contribute to a retirement plan for both of you underneath your business. So now instead of having a 25% deduction of your W-2 for you, now we get a 25% deduction for both of you, but he has to be on payroll. So it gets a little, I'm doing a very simplified
I see where you're
example.
going with it. It's kind of like the IRA is $2,500 for single, 5,000 for married,
It's 6,000.
6,000.
It's 6,000 each. And it's going up to 7,500, yeah. But you can put a spouse, do you have kids?
Yes,
You can also put your kids on and you can do educational IRAs. There's
I can
other
totally do that.
There's other IRAs that you can do, and there's other deductions. We're looking at a couple of different options for Kaylee and Josh as well. And that's the thing is, you need to. We throw everything on the table and we say, hey, here's all your options. what sounds and feels good. Some of them will be very obvious that they're not a good idea. If they don't save you a lot of tax money, then we're not going to do it. It doesn't make sense, right? We're not going to go cost benefit completely upside down. But if it saves you $3,000 and you need to invest $6,000, that's smart. Take $3,000 out of the IRS's pocket and give it to yourself.
Right.
Because that's a legal deduction. That's just knowing the rules. But yes, you can add your husband and there's certain things. But the biggest benefit to adding your husband would be when you get enough income that you can fund retirement planning, because now you can fund it for both of you. The only thing we would have to look at is what retirement planning is available to him underneath his regular W-2 job. If it's a 401k, we can still do IRAs. So SEP IRA would count. So now you can get double deduction on your business return instead of a single deduction. All those things are available.
Super cool. Plus, it's nice just to know someone has your back. Like, you don't have to be scared. Like, did I do it wrong? What's going on? You know, I don't know.
Yes.
It's just a really good option.
When it comes to all of these different deductions, you want to make sure you're doing them correctly. It's like Section 1031 exchanges. A lot of people think, oh, I just keep the money and then reinvest it in 45 days. No, you need to use a 1031 exchange. You need to actually identify the property within 45 days, and you need to have, the gain has to follow it on the balance sheet. And we've had a lot of people that come to us and are like, oh, I just took the money out of my IRA and I did a self-directed and invested. And I'm like, oh yeah.
Yeah, and you just
Well, they
pay.
owe some money.
My nervous
that
laugh.
bugs me too, because it's like you just withdrew the money, and now you have to pay taxes on that, because now you have no way of paying it back within the period of time.
Yep.
And I'm like, you have to think of it more of rolling your investments as opposed to withdrawing and investing.
Correct. And you can also do, and I'm gonna shut up in just like 2 seconds. There's one other thing that is very popular that a lot of people don't know about. It's called a self-directed IRA. Has anybody heard of self-directed? Mm-hmm. Okay, so you know what it is? Do you know what it is? This might be
it's the same thing
beneficial.
I'm already doing.
Self-directed IRA. No, this could be very important for your clients. So you can take your IRA money. So I'll give you my example. I had funded a simple IRA and a traditional IRA for me and for my husband for several years. I bought the building right next door to my office building. It's a residential rental. I took all of my IRA accounts. I had 4 IRA accounts between my husband and I cashed them all out. I sent all the money over to a self-directed IRA company. There's one here in Starkey. There's multiple ones. I just wanted to use a local one. I sent all the checks, opened up the account. I basically just transferred the funds IRA to IRA. In a self-directed IRA, you're allowed to pull out your IRA money to invest in real estate as long as it's not your primary home. So I pulled all of our IRA money out. I used that as my down payment for the building next door. There's no penalty because it's a valid investment. The investment in the property becomes your investment account. And then all I have to do is when I pay out dividends out of that LLC, if I pay out $1,000 dividend, a part of it goes to me personally, a part of it goes to my husband personally, a part of it goes to my husband's IRA account at the self-directed company, and a part of it goes to my IRA account at the self-directed company. And I can leave that money invested in that property as long as I want. When I sell the property, I have to refund the money in full that I originally took back to the self-directed IRA. Or if the property is cash flowing properly, I can refund that money and then I can pull it out all over again and invest in a second property.
It's like your own little piggy bank.
It's like my own little piggy bank.
Like it.
So you can put money, what we tell people is you can either fund it directly to a self-directed IRA or you can fund it to a simple IRA or a traditional IRA and then you can convert. If you have existing 401k money, maybe you had a W-2 job back in the day, maybe you have a 403b, you can convert that 401k or 403b into IRA money. And you can withdraw from that money to invest in properties. And it's all legal. It just has accounting rules that have to be followed.
So
And that's
not
the
all
trick.
of this is in your brain because the jumbled
That's
mess
why
in
she
mine.
said, when I said something about real estate, she goes, no, I know my
I know,
real house has
I know
to-
accounting and tax about real estate, but don't ask me to show
But I'm
somebody
the
a
same
house.
way. When people ask me like, hey, can I do this with my loan? I'm like, that's not a me question.
No, stay in my lane.
Yep. So there's a lot of different tips and tricks. Real estate is one of the very exciting places when you get into tax. When you're talking to people with high wealth and or people that are interested in what you're doing, invest in these properties long term, there are a lot of opportunities in the tax code, and most people are not using them because they don't know they exist. Or they're not using them correctly.
Yes.
And the key is if you're ever in an audit to know that your T's are crossed and your I's are dotted because you don't want to sit across from an IRS agent trying to figure it out at that time. It's better to do it right the first time.
How many new agents have they hired?
They're actually
Oh, yeah.
trying to reverse that now because
that
it's
would be nice.
costing a lot in taxes.
And supposedly they're all carrying weapons now? That's weird. Anyways.
If you carry a weapon and you're a property manager or you're a real estate investor, you can actually deduct the cost of the weapon.
Hey now.
Hey, I just did that.
Ami Tommy.